Right now, somewhere in your retirement plan, there is a single number, one number, and it decides whether the government takes back up to 85% of your Social Security check. The worst part? Most retirees don't even know it exists. You can have a modest pension, a small IRA withdrawal, even interest from a savings bond, and that one number crosses an invisible line the government set back in 1983 and never updated for inflation. The line is just $25,000 for a single filer. Cross it, and your benefits are no longer fully yours. Stay with me. Provisional income, a formula frozen in 1983 when the law first passed. Fewer than 1 in 10 retirees paid a dime on their benefits. Today, over half of all recipients cross that line. But there is a way out, and it starts with understanding what actually counts toward that number. To understand who decided your Social Security check should be taxed, you have to go back to the brink of a system collapse. In 1982, the Social Security Trust Fund was running out of money, literally. The program was weeks away from being unable to mail checks to 36 million Americans. President Reagan created the National Commission on Social Security Reform, a group led by Alan Greenspan, to fix the mess. Their solution was a package of changes signed into law in 1983, and hidden inside that package was one sentence that changed retirement forever. The commission borrowed 2 income thresholds already used to tax unemployment benefits: $25,000 for a single person, $32,000 for a married couple. If your income crossed those lines, up to half of your benefits could now be taxed. But here is the detail nobody talked about then, and almost nobody knows now. Those numbers were not indexed to inflation. Not then, not ever. In 1984, the first year this rule took effect, less than 10% of retirees owed any tax. The average annual Social Security benefit was around $5,000. A line drawn at $25,000 seemed comfortably beyond most people's reach. The politicians knew that wouldn't last. Congressional records show the lawmakers deliberately chose not to index the thresholds, intending that over time, the tax would gradually swallow more and more of the middle class. They wanted Social Security to be treated like a private pension, where only the part your employer paid for is tax-free. And they were counting on inflation to do the dirty work silently, year by year. They were right. Fast forward to 1993, and Congress added a second, harsher tier. Now, if your income crossed $44,000 as a couple or $34,000 as a single, up to 85% of your benefits could be taxed, not inflation indexed either. Today, the average Social Security check is over $22,000 a year, and the cost of everything else has soared, but those thresholds haven't moved 1 inch since the day they were written. The result: more than half of all beneficiaries now pay tax on their benefits. The Congressional Budget Office says the tax generates over $55 billion for the trust funds every single year, and that number will only climb. By 2050, projections show 56% of families will owe. Not because the law changed, but because it never did. Now, you might think you know how this works. You count your pension, your IRA withdrawal, maybe a little interest from the bank. If the total is under the line, you are safe. But that is exactly why the formula catches people off guard. The government does not use your total income. They use something called provisional income. And what counts toward that number includes things most retirees never see coming. That is Act 2. Provisional income sounds like some obscure government formula, but it is astonishingly simple. You take your adjusted gross income, add any tax-exempt interest you earned during the year, then add exactly 50% of your Social Security benefits. That final number is your provisional income. If you are single and that number stays below $25,000, your benefits are completely tax-free. Cross that line, and up to half of your benefits suddenly become taxable income. Cross a second line at $34,000, and up to 85% gets taxed. Those are the rules, hard numbers. No gray area, but what actually counts toward that number is where the trap hides. Take a man named Kenneth. He is 67, married, and retired. His Social Security is $24,000 a year. He has a small pension from his old manufacturing job that pays him $14,400 a year. That is $1,200 a month. Not a fortune. He assumes his taxes will be near zero. But then his roof goes bad. Kenneth pulls $10,000 from his traditional IRA to pay for the repair. That seems reasonable. A once-a-year withdrawal to handle an emergency. He files his taxes and gets a letter saying he now owes tax on his Social Security. He is confused. His combined income is only $38,400 between the pension, the withdrawal, and his wife's small part-time income. How can that be above any threshold? Here is how. His provisional income is not $38,000. It is his adjusted gross income, which includes his pension, his IRA withdrawal, and his wife's wages. Let's say that totals $48,400. Then you add in half his Social Security, $12,000. Provisional income shoots up to over $60,000. For a married couple, that is well past the $44,000 line where 85% of benefits get taxed. A single $10,000 withdrawal just turned a tax-free retirement income stream into a taxable one. And the kicker is what Kenneth didn't even realize counted. If he had a municipal bond fund, thinking the interest was tax-free, that interest gets added right into the provisional income formula. Tax-exempt bonds are not exempt from this. They count dollar for dollar toward the line. That means a retiree who thought they were doing everything right, choosing tax-free investments and taking only what they needed, can wake up to find up to 85% of their Social Security check owed to the IRS. But that is only one side of the problem. The other side is what happens to the tax rate itself when you cross that line, because it is not a flat 85% tax on the benefits. It is a phased-in formula where every additional dollar of income can cause 85 cents of Social Security to become taxable. That creates a hidden marginal tax rate that can be 40% or more, even for someone in the 12% tax bracket. And here is the piece almost every retirement advisor misses. The higher your provisional income, the more your Medicare premiums can increase. It is called IRMA, the Income-Related Monthly Adjustment Amount. So that single IRA withdrawal doesn't just trigger taxes on your Social Security. It can also raise your Part B premium by hundreds of dollars a month, permanently. Now, you might be thinking the solution is to stop taking money out of retirement accounts altogether. But that is not always possible, and it is certainly not the whole answer. Because the real lever is not how much you withdraw, it is where you withdraw it from. And that discovery is what comes next. Because where you withdraw from is the difference between a retirement where your Social Security stays in your pocket and one where the government takes back nearly every other check. And before I show you exactly how to manage that, you need to see what happens when you don't. Remember Kenneth? He pulled $10,000 from his IRA to fix a roof. That withdrawal boosted his provisional income past the second threshold, making 85% of his Social Security taxable. But here is what hurt worse than the tax itself. That extra $10,000 of income, combined with the newly taxable Social Security, pushed his total taxable income into a higher marginal bracket. He didn't just pay more tax. He paid a higher rate on the dollars he had already earned in his pension and his wife's wages. And then came the letter from Medicare. Medicare Part B premiums are not flat. They rise based on your modified adjusted gross income from 2 years prior. The income brackets are called IRMA thresholds. For a married couple, the first bump triggers at $182,000, which Kenneth was nowhere near. But the second kind of pain is for people crossing from the standard premium tier. For 2025, the standard Part B premium is around $174 a month. If your income jumps just $1 above $106,000 as a couple, you enter the first IRMA bracket and your premium rises to $244 a month. That is an extra $840 a year per person. For a couple, nearly $1,700 gone, on top of the tax bill, and the withdrawal that caused all of it was a single $10,000. So that roof repair didn't just cost $10,000. It cost the tax on 85% of their Social Security, the higher tax rate on their other income, and a permanent Medicare surcharge that stays in place for an entire year. The real effective cost of that IRA withdrawal was close to 40%, and Kenneth didn't see a single one of those dominoes coming. Now, the trap is even more dangerous for people who inherit retirement accounts. A non-spouse beneficiary who takes a lump sum distribution from a traditional IRA can spike their income so high in 1 year that they not only push deep into the 85% Social Security taxation zone, but they can also leap 3 or 4 RMA brackets. I've seen a retiree who inherited $150,000 in a traditional IRA, took it all in the year they were 65, and ended up paying more than $10,000 extra in Medicare premiums alone over the following 2 years. That is money they never get back. The decision was irreversible. And here is the part that should make you angry. The entire system is built around the traditional retirement account. For 40 years, Americans have been told to save pre-tax. Put money in your 401k. Get the deduction today. Defer the tax. What nobody explained clearly enough is that every dollar you withdraw later increases your provisional income. And since the thresholds were frozen in 1983 and again in 1993, those deferred taxes from your working years now land at a moment when you are living on a fixed income with less flexibility to absorb the hit. The IRS collects more than $55 billion a year in taxes on Social Security benefits alone, much of it triggered by IRA and 401k withdrawals. That number is not an accident. It is the design working exactly as Congress intended, but not all retirement dollars are treated equally in the provisional income formula. Withdrawals from a Roth IRA are not counted as income at all. They are invisible to the formula. Qualified charitable distributions from an IRA, where you send money directly to a charity, never appear in your adjusted gross income. And the order in which you pull from your accounts, which years you choose to withdraw more versus less, can keep your provisional income below the line that saves you from losing up to 85% of your Social Security. These are levers, specific, legal, and almost never explained by the people who manage your money. And in Act 3, I am going to hand you a worksheet that makes it crystal clear. The worksheet is built around a single question. What if you could see, before the year starts, exactly which withdrawals will trigger the tax and which ones will not? That is what a provisional income calculator does. You plug in your expected Social Security, your pension, any interest, and then test your retirement account withdrawals one by one. It shows you the exact dollar where your provisional income crosses the first threshold, and the exact dollar where it crosses the second. Most people never run this math. They hand their entire retirement to a tax preparer in April and learn the damage when it is too late to undo it. But if you run the numbers in November, you still have a window to change everything. There are 3 levers that actually move the needle, and they are all legal, all simple, and all under your control. Lever number 1, the withdrawal order. In any year where your provisional income is drifting toward the $25,000 or $32,000 line, you stop pulling from your traditional IRA and you pull from your Roth instead. Roth withdrawals are invisible. They do not touch your adjusted gross income, which means they do not touch your provisional income. You can take out $50,000 from a Roth, and if your other income stays under the threshold, you pay 0 additional tax on your Social Security. So a retiree with a mix of Roth and traditional dollars can actively manage their tax bill every single year, choosing which bucket to drain based on where the line sits. If you do not have a Roth yet, you can convert a portion of your traditional IRA to a Roth in a carefully sized chunk, a chunk small enough that the conversion income does not push you over the line that year. It is a multi-year dance, but the payoff is permanent. Once the money is in the Roth, it never counts against your Social Security again. Lever number 2 is the Qualified Charitable Distribution, or QCD. If you are over 70 and a half, you can send up to $105,000 directly from your IRA to a charity. That money never appears in your adjusted gross income. It satisfies your required minimum distribution if you have one, and it completely bypasses the provisional income formula. I have seen a retiree with a $30,000 RMD who gave $15,000 of it directly to their church through a QCD. That $15,000 did not count as income. kept them below the first threshold, and saved the tax on 50% of their Social Security, plus the IRMA-A surcharge. The total savings exceeded $4,000, and the charity got exactly the same amount. It is a win with no loser except the IRS. Lever. Number 3 is timing. You do not have to take distributions evenly every year. You can bunch withdrawals into a single year where you intentionally go over the line, pay the tax once, and then keep the next 2 or 3 years completely clean. This works particularly well for people who need a large sum for a one-time expense, like a new roof or a vehicle. Instead of spreading that expense over multiple years and triggering taxation every single year, you trigger it once, keep the other years pristine, and come out ahead on total tax paid. But here is the detail that flips the entire conversation. The Social Security tax formula does not just tax your benefit, it also determines how much of your benefit the government calls income when you apply for other programs. Things like property tax relief for seniors, veterans benefits, and even some state-based prescription assistance plans all use your federal adjusted gross income or your provisional income to decide if you qualify. So when you cross that line, you do not just lose part of your Social Security. You can lose benefits you didn't even know were tied to that same number. That is the hidden second layer of the trap, and it catches people years after the fact, in a letter that says you no longer qualify. Now, I want you to walk away with one thing. You are not powerless against this formula. The government froze the thresholds, but you get to decide what goes into the calculation. The worksheet is linked in the description so you can run your own numbers tonight. Print it, grab a pencil, and find your line. Because once you see it, you will never look at your retirement accounts the same way again. The system was designed to be invisible, to take back a piece of your Social Security, so silently you would just blame the cost of living. But now you know the line. You know the 3 levers, and you know why the thresholds were never indexed, so they would capture more of you every single year, automatically, without Congress ever having to vote on it again. Your retirement was never just about what you saved. It was always about what you keep. And this one number, provisional income, now determines more of your real income than any investment return ever will. The question is no longer whether you will cross the line. The question is whether you will plan for it or pay for it in surprise. If this finally made sense to you, if you see how that one number controls everything, then I have a resource that takes this further. The link is in the first pinned comment. A special offer for people who want to lock in control of their retirement taxes right now. Hit subscribe so you do not miss the next deep dive. Like this video if you believe every retiree should know this. And I will see you in the next one.